Tech stocks crash 40%. Banking crisis. Bond market turmoil. Same market, different results. A portfolio with 100% tech stocks loses 45%. A diversified portfolio loses just 12%. Diversification isn't about making more money. It's about not losing everything when one thing fails. If you've ever heard, "Don't put all your eggs in one basket," you understand diversification in theory. But most people have no idea how to actually do it. They think buying 5 different tech stocks is diversification, or owning 3 ETFs that all hold the same companies, or spreading money across multiple accounts but investing in the same things. That's not diversification. That's an illusion of safety. Real diversification means spreading your investments across different asset classes like stocks, bonds, and real estate, different sectors like tech, healthcare, and energy, different geographies like the U.S., Europe, and Asia, and different company sizes from large to small. According to Fingwood Asia and decades of academic research, proper diversification is the only free lunch in investing. It reduces risk without necessarily reducing returns. Today, I am giving you a simple 4-step plan to diversify your portfolio for 2026. Step 1. Determine your asset allocation. Step 2. Diversify within stocks. Step 3. Add defensive positions. And Step 4. Implement risk controls. By the end, you'll have a blueprint to build a portfolio that can weather any market condition. Let's start. Step 1. Choose your stock-to-bond mix. Asset allocation is the single most important investment decision you'll make. It determines 90% of your portfolio's risk and return. It's simply how you split money between major asset classes, primarily stocks for growth and higher risk, and bonds for stability and lower risk. Why does this matter? During the 2020 bear market, a 100% stock portfolio was down about 25%. A 60/40th stock bond portfolio was down about 16%. And a 100% bond portfolio was down about 13%. Bonds cushioned the blow. So, how do you determine your asset allocation? The traditional age-based rule is to subtract your age from 120 to find your stock percentage. So if you're 30, you'd have 90% stocks. If you're 60, you'd have 60% stocks. This works because younger investors have more time to recover from downturns. But a better method is to match your allocation to your risk tolerance. An aggressive investor with a 20-plus year time horizon might be 90 to 100% stocks, comfortable with a 40% drop. A moderate investor with a 10 to 20-year horizon might be 70 to 80% stocks, handling a 25% drop. A conservative investor nearing retirement might only be 50 to 60% stocks, preferring to limit drops to around 15%. For example, I'm 35 with a high-risk tolerance, so my allocation is 85% stocks, 15% bonds. Your allocation should let you sleep at night. So before we move on, ask yourself, what percentage in stocks can I commit to through a 30 to 40% market drop without panic selling? That's your stock allocation. The rest goes to bonds. Write it down. This is your foundation. Now for step 2, spread your stock exposure. This is where most people mess up. They buy Apple, Microsoft, Amazon, Google, and Meta and think they're diversified. But they're all US. Mega cap tech. If that one sector crashes, so does their portfolio. You need to diversify across 3 dimensions. First, sectors. Spread your money across technology, healthcare, financials, energy, utilities, and more. For most people, the simple solution is to buy a total market ETF like VTI or VOO. This automatically gives you all sectors. If you're an active investor, make sure no single sector is more than 30% of your stock allocation. Second, geography. Don't just invest in your home country. From 2000 to 2010, international stocks crushed U.S. stocks. From 2010 to 2024, the US dominated. Nobody knows what will happen next, so you own both. A good rule of thumb is 60 to 70% in US stocks, 20 to 25% in international developed markets like Europe and Japan, and 5 to 10% in emerging markets like China and India. For a $10,000 stock portfolio, that could be $6,500 in VTI for the U.S., $2,500 in VXUS for international, and $1,000 in VWO for emerging markets. The third dimension is company size or market cap. Large cap companies like Apple are stable. Small cap companies have high growth potential but also higher risk. A total market fund like VTI automatically includes all sizes. But if you want a more tactical approach, you could allocate 70% to large caps, 20% to mid caps, and 10% to small caps. So, to put it all together for an $85,000 stock allocation, the ultra simple option is $60,000 in a U.S. total market fund and $25,000 in an international fund. Done. You're diversified. A critical rule here is to set limits. No single stock should be more than 5% of your portfolio, and no single ETF more than 40%. Step 3 is to build your safety net. Stocks provide growth, but you need assets that protect you when stocks fall. The first defensive asset is bonds. Bonds are loans that pay interest and often rise when stocks fall. The easiest way to own them is through a total bond market ETF like BND or AGG. If your allocation calls for 30% bonds, you'd put 30% of your portfolio into one of these. Your second defensive asset is dividend stocks. Companies that pay regular cash dividends tend to be more stable. An ETF like SCHD holds quality dividend stocks and can provide income during downturns. Consider allocating 10 to 20% of your stock portion here. Third, real estate investment trusts or REITs. These own property and pay out rental income. They offer a hedge against inflation and behave differently than stocks and bonds. An ETF like VNQ gives you broad exposure, and you might allocate 5 to 10% of your portfolio to it. Finally, you can add commodities like gold. Gold is a traditional safe haven during a crisis. An ETF like GLD tracks the price of gold. This is optional, but a small allocation of up to 5% can provide an extra layer of protection. A moderate portfolio might have 70% in stocks, including dividend and real estate ETFs, and 30% in bonds. It has growth, income, stability, and inflation protection. Step 4 is to protect your diversification. It's not a one-and-done setup. First, stick to your position limits. If a stock like Nvidia triples and becomes 15% of your portfolio instead of 5%, sell enough to bring it back to your 5% target. This forces you to sell high. Second, rebalance on a schedule. Your 70/30ths portfolio might drift to 70/20 after a good year for stocks. That's more risk than you planned for. So, every 6 months or year, sell your overweight assets and buy underweight ones to return to your targets. Third, monitor correlations. You want assets that don't all move together. Once a year, use a free tool like Portfolio Visualizer to check. If everything is dropping by the same amount in a downturn, your assets are too correlated. And a personal rule: have an emergency stop loss. If my total portfolio drops by 40%, I have a pre-planned moment to review my allocation and see if I am still comfortable with the risk. This isn't panic selling, it's a planned reassessment. Finally, when you add new money to your portfolio, always buy the most underweight position. This is an easy way to rebalance without selling anything. Let's look at a complete blueprint. For a moderate $100,000 portfolio, $75,000 in stocks split between US and international index funds, a dividend fund, and a real estate fund. $20,000 in a total bond fund, and $5,000 in a gold ETF. This portfolio is balanced for growth and stability with an expected return of 8 to 10%. All right, let's wrap this up. The 4-step diversification plan is choose your stock versus. Bond allocation: diversify your stocks across sectors, geography, and size. Add defensive positions like bonds and real estate, and implement risk controls like rebalancing. Diversification won't make you rich overnight, but it will prevent you from getting poor quickly. During the 2008 financial crisis, a diversified 60/40 portfolio recovered 2 years faster than a 100% stock portfolio. It's your insurance policy. Drop a comment below with your current allocation. I'm X% stocks, Y% bonds. Does your portfolio match your risk tolerance? I'll review comments and provide feedback. I've also created a free portfolio diversification worksheet with an allocation calculator, rebalancing trackers, and all the sample portfolios we discussed. The link is in the description. Subscribe for weekly investing strategies that actually work. No hype, just proven portfolio building. Hit like if this gave you a clear plan, and share it with someone who needs to spread their risk. Remember, the goal of diversification isn't to maximize returns. It's to achieve good returns while minimizing the chance of catastrophic loss. You can't control the market, but you can control your risk. Build a portfolio that survives, and you'll be around long enough to see it grow. Thanks for watching. I'll see you in the next one.